Get that shopping list ready because the pullbacks in the US are happening on light volume, but the critical piece of the puzzle is finding companies in the right and strong industries to add to the portfolio. As we go through Gary Glover's report this week, we're looking for companies that are positioned in those strong industries and have reported very well, with also the ability to increase their earnings in the years ahead. Gary's been through the charts and he's going to guide us through the report. Good morning, Gary. How are you?
Yeah, I'm good, Chris.
I'm reading this report. I was happy to see that you're looking at those, really highlighting the importance of those industry sectors to show where you're going to pull the next trades from. And we will get through them, through to those trades and the individual charts in a second. But as we look at the NASDAQ, we're sitting here and seeing that it has pulled back a little bit and is coming back sort of after that breakout. But what are you looking for to happen from the NASDAQ from here?
It's funny. It's a bit of a funny week there for me. I was I was thinking at the sort of start of the week there, I guess before Monday morning there, that how is the best, positioning right now? Like, where should we be positioned? So we've been talking about commodities, some vulnerability there, and obviously we're starting to see some of that vulnerability in the last week or two. We're talking about basically sort of like inflation, which is still pretty high. So normally, energy, precious metals, and then your value shares obviously perform pretty well there. So if inflation stays high, then only one of those three will maybe hold up if inflation comes off. So, which is kind of the value end. So the other two have sort of got some risk here if inflation does cool off. And we're starting to see signs of the other ones sort of cooling off as well. And then if we do get a bit of if inflation does cool off here, then potentially like 02, 03 there, we might start to see growth build and, get a move on there. So to me, I was sort of thinking, okay, look, from a safety point of view, you probably would want to be maybe 2/3 sort of value here and maybe 1/3 growth, because, and then just avoid commodities altogether. Just I think it's too risky there at the moment until there's sort of a clear signal somewhere. And the only commodity which is interesting to me is actually gold, because we had that big rally here recently, Chris, and now we've pulled back again. So I'll be watching for that to sort of maybe try and find a bottom. And I think gold is normally more aligned with the overall market than it is overall with as a hedge or anything else. But yeah, it's just an interesting sort of period here. So I'm probably personally going to be a little bit more slanted towards growth there. Maybe take a little punt there that might be an area that outperforms and get a bit more beta. But to the average client there, you probably want to be 2/3 value, 1/3 growth is sort of, just because if inflation hangs around, at least the 2/3 of the portfolio is going to outperform. And then, but if inflation does ease here, then that growth really can sort of do the heavy lifting and get going, and that'll give you the outperformance as well. So just a bit of a hedge on either side there, just because the two sort of possibilities are sort of, not necessarily far apart, but there's a lot of sectors which will do very differently in both different environments there. So, whereas I think if you just stay with industrials, the quality end, sort of lower PE, sort of high yielding sort of stocks, that they'll do quite well in both environments. So probably they'll do modestly in a growth environment, but they'll do well in a high inflation environment. So they'll sort of get the pass mark in both markets. Growth will obviously underperform in a high inflationary market, but shoot the lights out if inflation does ease off here, the money will flow back into growth. So that's sort of the safest positioning that I sort of thought anyway here. But me personally, I'm sort of probably might slant myself a little bit more on the growth side there, just because I do like what's happening here with the NASDAQ, and that it has sort of gone to a new high, has pulled back into the range here, and just similar to 02, 03. And I know I sort of keep mentioning that period there, but it did sort of build there. So I know we showed a chart there last week, Chris, but it took 30 weeks to sort of break above here. And this one's sort of 15 weeks, but this is sort of half the decline of the other one. So I was looking back at sort of 62, 72, I think 92 as well, and then obviously how they slow into the third year, sort of 93 and 73 and 60. And just definitely saw some similarities in that move there. And as we mentioned, like a lot of the key lows in those midterm years and also in the second years come in the October period, and then we sort of start to build from there. And oftentimes this sort of end of February, early March is a low as well. And that's kind of the key timing we're looking for here. And looking at a lot of those sort of third year, the decade cycle there, I noticed that they would sort of build like an overlapping nature, Chris. So they sort of like hit the low in October, run up, pull back and make a first high low, run up again, overlap again, make a second high low, and maybe even overlap a third time. So you're almost building a base initially. So you're not impulsively getting going here because they've obviously been pretty decent decline, a bit of a growth crunch. So it's a building process there. So all we really want to see here from the NASDAQ and the S&P 500 is a series of high lows building here. So as long as we don't break the swing low, that's a positive sign there. So I only saw, I think when I look back through about 8 years of those sort of similar cycles, I only saw one actually break a swing low and then still recover. Whereas 100% of them actually just kept making high lows. So built, but built with a sequence of high lows there. So that's the ideal scenario here, the ideal sort of construction. And we just don't want to see any heavy selling out. I just haven't seen that heavy selling, Chris, as well. So the selling's been pretty mild. They've been pretty measured, the pullbacks, nothing aggressive.
That's what you were talking about with the NASDAQ in your report, saying no signs of distribution so far, right?
Well, we've seen a couple of big range days where the market's been, I'll say, 2.5%. So where it's gone through a bit of traffic and the volume's light. So if you're moving a 2.5% intraday range, you should be knocking out tons of orders and the volume should be up. Not seeing that. So it's been a few days where the market's down and then just sort of stays in a tight range for the day. That's understandable, but just haven't seen any aggressive selling. So not sort of, I think there's only been like 1 or 2 distribution days in the whole period there, whereas normally sort of, you'd normally see 4 to 5 before you get bearish. So I think we've sort of seen 2 maximum on any of the indices so far. So we just haven't seen many distribution days at all. So it's funny how we've just fallen right into this window. So really sort of start of March, usually the first day or 2 of March is the sort of, that's the ideal timing for a high low here. So we're right there. So hence why I'm sort of starting to look at a few longs here, starting to add a few. So
we'll have a look at some of those in a minute because you've got the charts. But if we go to the other side of the coin or the other side of the globe as well, we're looking at the Australian market and you've got signs of distribution taking place. I noticed that you mentioned in your weekly report seeing pressure both in the bank or possibly in the banks, in the miners. We saw Fortescue go X yesterday as well, which always adds a bit of volume. But is that where you're seeing the distribution and a lot of the volume come from?
Yeah, the Aussie market looks a little different to the US indices in that the selling has been up. So the actual volumes off the high, so we have got that high volume into the high, which is a little bit exhaustive. And then we've seen pretty heavy selling each week here. So we actually we're seeing more weakness in the Aussie market here, which for a while here, I've been really concerned about commodities and materials, energy and the iron ore sort of sectors there, just because they ran up there, and towards the end there, it was sort of very reminiscent of the 07, 08 high. Was that the volumes were very lackluster, sort of heading into the high. So we're sort of going higher for like 7, 8 weeks there, but the volumes were insipid, were very, very light. So and now we're starting to see, we've seen BHP and Fortescue and Rio start to break down here the last couple of weeks. So just showing a bit of vulnerability there. Obviously the energy sort of complex, coal stocks have come off as well. So they're all good for inflationary pressures easing as well. But just the price action there is just telling me to be concerned there. That's why I'm finding that, people keep reaching me out and say, oh, you should, you need to have resources, you need to have BHP. Well, the price action is telling me to be very, very careful there. And history tells us that when they look their best in terms of having low PEs and high yields, it's usually top of the cycle stuff as well. So, I'll prefer just to stay away. If it's too hard to work it out, I'll stay out. But there's a risk there. I just see some risk in that sector there. So we know sort of in the last growth crunch there, I think our market found a low quite a few months later, than the US and in '02, and that was all about commodities, being the sort of third asset class and finding a low last in the in those measures. So for me, too tricky. The concern here is that maybe our over reliance on resources might drag our index back a bit, but maybe we'll hold back here. I mean, the good news there is that some of the stocks are starting to cool off now, Chris. So seeing the banks have a decent pullback, resources had a bit of a decent pullback, even some of the lithium stocks as well have a bit of a decent. So it sort of hasn't come back that deep, considering a lot of the stocks have come back quite a bit, and that's a good sign. So maybe some other sectors will do a bit of lifting here and hold the index up while those main companies have sort of done all the heavy lifting previously. So that's why I think it's the sectors will be super important here moving forward.
Well, to round out the indices, we jump back over to the US, go to the oldest indices, the Dow Jones, and look at that. It's been super tight in that consolidation. And then it's just over the last couple of weeks really dropped back down, which is kind of what you said you were looking for, a Feb, March low. Would you expect to see it kind of hold around these levels and hopefully recover, or something else?
Yeah, I'd love to sort of see it come back to that, say, 32, 270 level. That's sort of a bit of a Feb level. It sort of matches up with the left-hand side as well there, back in early 22. And that would be a nice little symmetry there, almost like a little bit of an inverse, head and shoulder sort of pattern in there as well. Just some nice little ABC symmetry. Come back, nice and sort of have a modest sort of pullback there, and then start to build again. I do like the fact that down the bottom, Chris, there we've got this Williams, this Williams percentage R indicator. This is something I've looked at historically there on weekly charts. And it's not good for sells. It's because it can be sitting in the sell zone a lot there, but it might give you one or two good buys not every year, but maybe every second year when the market is really oversold. And I find that the deep lows can give you a good sort of indicator, and then the first high low, I find it's a good indicator as well. So we sort of saw there in 2020, that was a deep low there, and then what the time there, sort of October 2020, like a little ABC, that was the first high low. So that was, our indicator was saying that was just as almost as oversold as the previous low, but the price hadn't come back that much. That's always a good sign when you see that. So, because the price hasn't come back much, but your indicator's come back in the range there. So we've got the same sort of technical setup here right now to this. So I don't look at this too much, because it really only gives me maybe one or two signals, or probably gives me one signal every 18 months at probably best. But this is interesting here, just because it's sort of now showing the market pretty oversold there, almost as oversold as in October, even though it's been pretty, and looks mild on the chart there. So if it hits that range and sort of shows some support here, it's definitely worth following here. So just like what I'm seeing there as well, just might need a bit more. This week will be pretty important. I just think you might see a bit more mild weakness here this week. But we're going to be, looking for a bit of a reversal next week. I'll personally be sort of trying to add a few stocks into the portfolio here this week here. Already started, so yeah.
Well, that's probably a good point to switch over to the individual shares. You start off with Australian Clinical Labs, ACL. Now, volume's got to be key on this. When we have a look at this chart, you've got this massive candle here, huge bullish candle, and then a good volume coming in there too. So do you want to walk us through this chart?
Yeah, so we've got obviously a nice little descending wedge there. We've also got, a retest of that low, like a little false break in Feb, and then didn't follow through. And then we've got, a nice update and the stocks, really taken off there. So in that sort of pathology area, Sonic Healthcare also had a pretty strong result as well. So both sort of similar looking sort of charts there, just showing, real sort of strength there. And, if you look at the reports there, it sort of talked about, expecting growth, in the forward the next sort of, next sort of year or two. So they're sort of pretty well positioned there, after some pretty tough years through, through COVID. I know they're doing a little bit of business through COVID there, but normal operations there will sort of start to pick up there. So we really like these two. Price action is pretty encouraging there. Just looking for a little bit of a softer entry there. It's obviously sometimes when you spike like this, you might sort of drift back in the range. So we're just looking for a little drift off and then, trying to add it in there. So these are sectors I really want to be long here. So I think, again, they'll hold up, whether it's a high inflationary environment or not. I think healthcare will still do pretty well. I think sort of COVID, I think sort of the worst of COVID is behind us here. I think healthcare will sort of normalise here. And I think pathology will sort of do well here the next couple of years there. Same story about health, same story for Sonic as well. I think, they're both sort of showing real strength out of the lows there. Just got a bit oversold there. And those are good signs. They're sort of, basically sort of springs there, as we know there. Chris off the lows there, nice sort of really impulsive moves after sort of going to a false break here. So that is a sort of spring, big spring there, big volume there. So, showing signs of accumulation there. So again, just looking for a little bit of a drift off, put in a higher low sort of somewhere, and looking to sort of add these. So I've already, so both of those looking to add some of those. I've already got some Sonic there, probably add a little bit more if it drifts off. ACL looking for it to drift off a little bit. Just trying to sort of maximise the risk reward sort of settings there.
Now, another one in a very different industry, you've got automotive, AP Eagers. We've seen this rally. So I remember you talking about the October lows and how it was important to see some companies making higher lows throughout that period.
Yeah, exactly.
So in your weekly report, you'd called it well. You said a June low, then we had a mid-August high, and then we came back to the October lows, which were for the market. We look at AP Eagers. They made a higher low into October, and they've kind of been VCPing or consolidating around there before this big explosive coming off the report. So what are you looking for with Eagers here?
Yeah, you got your pennant flag, got your VCP all sort of tightening up in there, and then, it's a corrective move after an impulsive rally up to the high. So all the good signs that we want to see there. And then we saw volume starting to accumulate at the low, and then we got the report and it sort of popped through the range there. So that looks pretty positive there. Again, we've just had a bit of a pop here, pretty aggressive pop. So I think, again, if it drifts off a little bit back to 13, just sort of sweetens our risk reward. But we should sort of, see a decent move up to, 1550, maybe even a bit higher than that. So, but just trying to sweeten the risk reward there in terms of setting there. So I do like that one as well. As we know, Chris, when typically companies report pretty well, obviously get upgraded there, and they tend to outperform, for the next few months as well. So,
Well, it's a good setup, a good structure, and good fundamental reporting behind it. Another one that's, going into a different type of leader. You've talked about this, you spoke about it last week as well, about Clinuvel, and you went through and pulled apart some market leaders for a long time. And you said on the weekly chart, which you've put in here for Clinuvel, is that when they pull back, quite often they'll only pull back a maximum of 4 weeks before they can reload and go again. So is this trade possibly fitting into that kind of research you've done?
Well, I thought that might be the case, but it has gone lower this week. So this is the 5th week, and it's sort of come off a bit impulsive there. So look, a few did go 5 weeks, but majority sort of really was sort of in that sort of 4-week range. But I know sort of with the sort of biotech and even sort of healthcare sort of stocks that really do move, the thing about the pullbacks is they're always sort of short and sharp, Chris, as well. So they're just not, you're sort of, it's the opposite sort of almost like a bear market. You're sort of decline, and then you have these, the bear market rally. It just pops, and then decline, and then it rallies up really sharply, and then decline. So this is sort of the opposite there. It'll sort of climb slowly, and then kind of release. Make a higher low, and then climb slowly, then release. So that's how they sort of set up normally. So normally the pullbacks are sort of short and sort of sharp here. And if you look at that, if you Google Livermore's speculative charts, his what do you call his accumulation sort of cylinder with that widening mouth, sort of got that type of appearance as well. But they just sort of release pretty quickly. So always a bit tricky there because it's can be lightly traded, Clinuvel. So definitely was probably one that sort of caught me out a little bit there. I sort of bought a little bit early here and then bought a little bit more yesterday. Don't really like to be buying. I normally like to be buying on the way up rather than the way down, but it's just not the most liquid sort of share. There's pretty tightly held, so it is sort of hard to sort of set in here. But I do like the growth profile here, and I like what I've seen so far here. Obviously, the last few days it's sort of come off a bit harder there, but it's not unusual to do that. So so I have been adding a little bit there. I've just remove my sort of stop, give myself a little bit more room here until it sort of settles down a bit. But again, it's been pretty lightly traded here. Really, only the last couple of days we've seen some volume here. So I do like that one, even though it's sort of come back a little bit further than I thought. I think it's sort of come back to $19.50 or something today, or $19. It's come back a bit further than the range. I think it might have come back to the 50-day moving average on the weekly. But yeah, so it's come back a little bit further than I hoped there. But yeah, I still do like it actually. Still do like it, but it's just a tricky one to trade there. Those biotechs, they can be a little ferocious there. So it's always sort of nice to add sort of slowly bits, add a bit at a time. So that's what I've done so far.
Well, that's Clinuvel. If we look at another one, a different sector again, corporate travel. So you've covered travel for quite a while, especially throughout COVID, looking at those who raised funds, how they diluted themselves, what their total market cap was. But corporate travel was one that you said didn't have to go and raise capital from the markets. So that's putting them in a stronger position to recover from here on. And if we look at the chart that you've got here, we see this massive volume happening here on the chart and then a bit of a pullback. But if we look where that massive volume happened, it's this where it's a bullish candle, but actually this downward week here shows that there was intra-week reversal. So maybe accumulation happened down here quite heavily. How are you interpreting this chart for CTD?
Yeah, this is an interesting one actually, because if you looked at reporting season there, you would have thought, that's a pretty good result. And then it got actually pretty hard on the day of its result. I thought, wow, okay, that was a pretty good result. And then the next day, it did a full recovery the day post its result. So you might have been shaking your head a little bit. And that's sort of probably the one in the reporting season that I sort of looked at and thought, oh, that's a little strange activity. Normally, most of the activity makes sense a lot of the time, but definitely a bit of a shakeout in there. But I mean, just looking at that sort of descending wedge there, we sort of overshot the low, good volume down at the low, had a pretty nice impulsive rally out of that low, and now we're sort of trying to build the first high low. So again, we've got that little inverse head and shoulder pattern there, Chris, as well. Might need a bit more time in here. So might sort of meander back into the sort of 1650 zone. And then, but I like the price action is, I think the sector looks pretty good. I mean, it's, these guys have sort of managed their finances better than anyone else as well. So, so I do like to look at this. Obviously that obviously travel sector sort of, the numbers everyone's posting is pretty buoyant, pretty positive. Definitely seeing a recovery in that sector. So I think that's sort of, I know interest rates are moving higher, so that might ease off some of the discretionary spend there, but considering we haven't been able to travel for 3 years, I still think people are kind of wanting to travel here. So everyone I know is sort of still planning a travel trip. So, I still think this is going to be pretty robust there. And they'll sort of go back towards corporates as well, traveling. So I think this one looks decent here. It's just all about trying to get a good risk reward as well. So, kind of waiting for a little bit of weakness there, and then, just trying to add some, into some weakness there and try and get a good risk reward as well.
Well, if we move into another company that was hit very hard during COVID, but the Star was also hit for many other reasons, where they are right now, I love seeing this on your charts. You've got FB, false break, or the spring that we can be called. Huge volume down here. And then similar kind of thing. This weekly chart is showing that prices got pushed down sort of that 120 area, but closed the week above it. So what's your interpretation of this setup?
Yeah, I did sort of see that big move down originally. Big volume there, looked exhaustive, and then it sort of rallied there, but then it sort of rolled over again. Because I sort of had a little position in there and got sort of stopped out in there. But now it sort of has gone back and retested that old low. So I was mindful of that. We weren't far away from that old low. But now we have gone to that new low. And probably the most important thing there, Chris, is just, the company's been forced to do a massive equity raising here, at its worst time. And this is sort of typically what does happen there. We saw it with, Webjet, Flight Centre, Qantas having to raise back in 2020 when, COVID first started, no one was travelling, and obviously liquidity issue and the share price were all in, decline there. So you're always basically forced to raise capital at the worst time and raise money here. And this is sort of, in the past there, I'd probably say 90% of these big raises here are sort of at the stress periods. So 9 out of 10 times they are at the lows for the companies. It's just sort of at the worst possible time here. So, I've done a 3 for $5 at $1.20. And just the way that, the share price has actually held up pretty well here, considering raising capital lower price there. So it's held on pretty well here. So I think this is, it's not great what's happened here, but if history is any example here, this is usually sort of the time when where these things mark their lows, and it gets rid of any sort of capital liquidity, financing issues. So they just need to sort of sort out their casino license there in Sydney. If they can sort that out and get their sort of get things in alignment there, you might recover. Quite similar to Crown there. I thought might have been the low there sort of a few months ago, but obviously this is I think just very reminiscent of what happened with the Crown there. We saw Crown's recovered there. Someone's one of the assets, and it's obviously got sort of taken over. I'm not saying this is going to be taken over here, but I think there's a good likelihood there. We've probably seen the worst. Probably gone through there. I think the company's probably gone through 95% of the worst sort of stuff here. So, so I think you'll sort of see this just climb slowly from here.
Well, the last one is possibly the tamest chart of the lot. Now, looking at this, volatility is much tighter than that of the Star and almost all the others. So when we look at Bapcor, we think about autos as well, which AP Eagers is in that space.
Yeah.
And you know,
a strong segment, really, isn't it, Chris? I think, obviously, because no one can sort of get cars, so the used car market's been pretty robust now. So I saw everyone sort of talking about used car market starting to sort of slow down now, which is fine there, probably because you can finally get a new car now, so whereas you couldn't get them previously. So
I know people are still on waiting lists and been there for 18 months or so, 2 or 3 years. But
so you might see that used car market slow down, but that just means the new car market will pick up the slack there. So, but yeah, look, I think this one looks pretty interesting. And just the fact that it's a fairly sideways orientated correction as well. Got a little false break of that little low there. It just held up pretty well considering the market here. Again, made the high low in October. And the whole thing's like in a bit of a box there. So I think Davis would call this sort of $7 to $6 there, a bit of a Davis box. If we break out of that top side there, you can more than likely break out to the size of that box, which is up towards $8. So the most impressive thing there is the volume the last couple of weeks is pretty robust. So I think that looks pretty good. So I just sort of got a small position there just because it's not one of my favourite positions, but it still looks pretty tidy.
Well, the last one of this week's report is you've got Audinate Group in here. So we're talking about large volatility, big swings coming back here, sort of 11, getting to $11, down towards 5, rallying back up to 10.50, and then it's just narrowing and then getting in tight within these, triangle that you've got happening?
Yeah, so we've got a little isosceles triangle there, but we did sort of break a little bit below that triangle, but in terms of our VCP sort of pattern, Chris, it still meets our VCP criteria there. Each correction's gotten smaller in length there. So, and then we've just sort of broken above that little swing high there, which they can do. Sometimes you get a little shakeout there. But yes, it looks pretty good there. I mean, again, I think the volume's pretty decent there as well there. Some pretty good volumes off that low there.
So really contracting in the tighter part of the chart as we look at this tighter consolidation compared to the left side. That volume's really dropped, hasn't it?
Had the little shakeout to the bottom. Volume stepped in, and then the following week we saw volume popped and then it broke out the top side. So, sort of from my experience, I sort of found out, if we've got a rectangle and we get a breakout of the bottom side, and then sort of like within one day it basically breaks back in the range. You don't wait for it to go to the top of the range and break out. You buy that long there. So if you get a false break of that sort of so you've sort of got your Davis box there, your sort of or your range there. And it breaks out of that that range, but only really lasts a day or 2 maximum, and then breaks back in the range the following day. That's for me that's a long trigger there. So we've sort of got short-term break of that range there, and then gone straight back in there the following day. So and gone back and with a bit of volume as well. So typically we get a break like that. That's that's a bullish sign here. So I know this is sort of one of those preferred growth stocks there. Had a pretty impressive growth. I think revenue's up 39%. It's with these companies, it's all a bit about their trying to get back to sort of, break even there, and then obviously getting in, as you get sort of scale, then you're sort of getting into growth. So some of these better growth companies will be, some of them will be already profitable, but the other ones will be sort of hopefully approaching profitability as well. So those are the two that the market really wants to see, as sort of the ones that are making profits, of course, and then the ones that are reaching scale and approaching being profitable as well. So yes, this looks pretty interesting as well.
Well, there's some definite themes in there to be looking at the companies, the criteria you've also mentioned, as you said at the start. You want them to be having a good growth profile. Clearly, 88 fits into that. So that's a good way to be looking at the market. As you've also mentioned, you were looking for late February, early March lows. Here we are, 28th of February. We've got possibly the lows around the corner. Your history shows that that might have been the 1st of March or the first couple of days of March, and you've got a short list of companies to work with. So is there anything else you'd be looking into, or that's the week ahead for you?
That's pretty much it, really. So just looking to add a bit of, a few longs in here, because I've sort of been a bit light on the portfolio. So trying to add a little bit of value there, but and add a bit of growth as well. So I try and add a bit of a mix. For clients, probably, as I say, 2/3 value and 1/3 growth, and then maybe as we get more confident, we'll start to, add a bit more growth in there. Try and grow that side there. So, but at this stage, I think it's constructive. I know there's some headwinds out there, sort of interest rates moving higher. That's going to, but that's sort of the building process. That's sort of why we sort of get, this will be a bit of a slow moving market initially, and you will get a sort of set of high low sort of building up here. But yeah, it fits into the cycle, fits into the sort of setup here, how you normally sort of come out of these growth crunches. So until I sort of see really any aggressive selling, Chris, particularly in the US sort of stuff there, or breaking a below a swing low and stuff. Until that happens there, I'll sort of maintain my view.
Well, that's a good way to run into the week, the month of March. We've got the roadmap ahead for us. So we say thank you very much, Gary Glover from Novus Capital.
Thanks, Chris.
Gary's mentioned his Friday inputs where he's looked at some charts broken down like Clinuvel. That's on the right-hand side, that whole playlist. And then also the strategies that he's talked about. He's talked about volatility contraction patterns, false breaks or springs. There's a whole series of those patterns and economic insights where Gary's really compressed the research that he's done into some snippets. Thank you very much for watching.